welcome to the deep dive. You know, we're on a mission today to cut through all the noise and find those real aha moments without giving you a headache from information overload.
Right, exactly. We want to focus on the actual mechanics of what's happening.
Yeah, and today we're looking at a pretty massive blind spot in the global financial landscape. Because right now, if you look at the two biggest tech companies processing the financial apps on your phone.
The famous U.S. giants, right?
Exactly, the ones everyone always talks about. They are currently celebrating a top-line growth of roughly 4%.
4%.
4%. It's safe, it's steady, and it is honestly completely pedestrian. But if you look just slightly south to Latin America, there's this entirely different reality unfolding.
Yeah, the contrast is, it's staggering.
It really is. You have these fintech companies moving billions of dollars, and they're growing their revenues at a massive 45 to 65% clip.
Right. They're achieving hypergrowth by literally any definition.
Yeah.
But the broader market is currently punishing them.
And that is the paradox that we are unpacking for you today. You have this spectacular, eye-watering revenue growth. But these businesses are seeing their stocks just head south. Yeah. They are trading at incredibly steep discounts. We're talking 27%, 28%, and even 38% off their recent highs.
Wall Street is basically pricing them like they've stumbled, even though they're running faster than ever.
Which is wild.
It is. But to understand that disconnect, we really have to look under the hood, because while these companies share a broad geography and obviously that spectacular growth profile, they're not identical at all.
Right.
They have totally different business models, unique specialties, and very distinct territorial ambitions. We really can't treat Latin American fintech as just this one monolith.
Okay, let's unpack this. Because to really understand this boom, I think we should start with the most established player in the region, just to ground you, the listener, before we look at the challengers.
Makes sense.
So, Mercado Libre. If you hear that name, you almost certainly think of e-commerce, right?
Yeah, it's widely known as the Amazon of Latin America.
Exactly. But looking through the sources today, I'd argue Mercado Libre operates much more like a financial Trojan horse.
Oh, I like that analogy.
Right. Because it's labeled as an e-commerce business from the outside, since that's how it started. But the real aggressive army hiding inside is its financial wing, Mercado Pago.
Yeah, and the underlying data absolutely backs that up. The financial wing has completely overtaken the retail side.
It's crazy.
In their latest quarter, Mercado Pago facilitated $83.4 billion in payment volume.
Okay, wait, let's put that in perspective for the listener. $83.4 billion. How does that compare to the actual physical goods being sold on their website?
It's 4 times higher.
Wow.
Yeah. The volume of money moving through the fintech side is literally 4 times larger than the gross merchandise value of the actual e-commerce platform.
And just to be crystal clear, when we say gross merchandise value, we are just talking about the total dollar amount of all the physical stuff, like the electronics, the clothes, the books, that people actually bought on the Mercado Libre website, right?
Correct. The physical retail sales are completely dwarfed by the financial transactions. And on top of that, the fintech business is growing way faster, which is what's driving the company's overall revenue growth of 45%.
Which is huge.
Yeah.
But that 4-to-1 ratio tells such a fascinating story about human behavior. It means Mercado Pago is no longer just the checkout button you click when you buy a toaster on Mercado Libre.
No, not at all.
If the payment volume is 4 times larger, people must be using it off-platform constantly.
They are. They're using it everywhere. The retail marketplace was essentially just the ultimate customer acquisition tool.
Right. It forced you to make an account.
Exactly. It forced consumers to trust the system to buy a physical item. And once that habit was built, the payments infrastructure just kind of escaped the website.
Like it broke out of the ecosystem.
Right. Consumers are using Mercado Pago in their daily lives now to pay local merchants, split restaurant bills, handle peer-to-peer transfers. It has become foundational financial plumbing down there.
But this brings me right back to our central paradox. If the fintech side is this absolute juggernaut, 4 times larger than the retail side, and pushing overall revenue growth to 45%, why on earth is the stock down almost 40% from its all-time highs last summer?
What's fascinating here is how the market weighs future potential against present reality. High growth doesn't automatically make a stock cheap.
Right.
Right now, Mercado Libre is trading at a beefy 30 times this year's projected earnings.
Let's pause on that phrase really quick. Trading at 30 times projected earnings. Just for the listener building out their analytical toolkit today, that price to earnings multiple is basically the market deciding how many dollars it is willing to pay today for $1 of this company's future profit.
Precisely. And investors are paying a hefty premium. 30 times earnings is a very high expectation.
Yeah, it is.
Now, that multiple drops below 22 if we look out to next year's estimates, but it still requires the company to execute perfectly. And right now, they are facing massive operational friction in Brazil.
Which is their largest market.
Exactly, their largest and most important market. And they're fighting a brutal local turf war there.
Yeah, the sources highlight some severe margin pressure in Brazil.
Right. To stay competitive against local rivals, Mercado Libre actually had to take a hit. They deliberately lowered the order size requirement for customers to qualify for free shipping.
Which is, fantastic if you're the consumer buying stuff. But from a business perspective, that eats directly into their profit margin.
Oh, yeah, absolutely.
I mean, let's think about the mechanics of that. Brazil is this massive country with notoriously complex and expensive logistics.
Very expensive.
If you lower the threshold for free shipping, you are suddenly absorbing the delivery cost on much smaller, way less profitable orders just to keep that buyer from, opening a competitor's app.
Right. The logistics of final mile delivery in Brazil are incredibly capital intensive. You need physical delivery vans, massive fulfillment warehouses.
Right.
Mercado Libre is spending heavily to maintain its own network to ensure speed and reliability. So when you combine those high infrastructure costs with eating the shipping fees on smaller orders.
Your margins just get crushed.
Exactly. Wall Street analysts see that margin compression and they pull back. That operational friction is a primary reason the stock dropped. Even market leaders face the brutal realities of local turf wars.
They are essentially buying their continued market dominance with their current profit margins.
Yeah.
Defending a local monopoly is just incredibly expensive.
It really is.
Which begs the question, is there a way to capture this explosive Latin American growth without actually fighting a costly ground war in any specific country?
There is, actually, but it requires a complete pivot in the business model. And this brings us to a company called dLocal, which is based in Uruguay.
Okay, so if Mercado Libre is the Trojan horse fighting a ground war in Brazil, dLocal operates more like an international digital toll booth.
I love that. A digital toll booth.
Yeah, they're laser-focused on processing payments, but they succeed by actively avoiding reliance on any single geographical turf.
Right. And the volume flowing through their system is surging. They just posted a 70% increase in total payment volume.
70%.
Yeah, which fueled a 65% rise in revenue. But the most vital statistic for understanding their strategy is their geographic diversity.
Right, because no single country accounts for more than 19% of their revenue.
Exactly. And over 20% of their business last year came from outside of Latin America entirely.
Wait, really?
Yeah, places like Egypt, various countries in Africa, and Asia. Cross-border payments actually accounted for half of its volume heading into 2025.
That is wild.
Yeah.
I want to drill down into the mechanics of that for a second.
Yeah.
Why is cross-border payment processing such a lucrative toll booth to operate?
Well, think about the friction of the traditional system. If a digital merchant in Europe wants to sell a subscription to a customer in Egypt or Indonesia, they usually have to navigate an absolute labyrinth.
Sure.
They have to deal with legacy correspondent banking networks like SWIFT. They have to manage volatile currency exchanges, comply with vastly different local financial regulations.
And integrate with entirely different local tech systems.
Exactly. It's a total nightmare for a global merchant to set up localized payment infrastructure in emerging markets.
So dLocal steps in and does all the heavy lifting. They navigate the local regulations, they set up the local banking partnerships, and then they just hand the European merchant a single piece of an API.
Right. Once that digital infrastructure is built, the merchant just plugs in the dLocal API, and suddenly they can accept local payment methods in dozens of emerging markets instantly.
And dLocal collects a toll on every transaction that crosses that digital bridge.
Precisely. And because no single country makes up more than a fifth of their revenue, they isolate themselves from the exact kind of local turf war Mercado Libre is fighting.
That makes total sense. If Brazil changes its tax code or some competitor slashes prices in Mexico, dLocal has a buffer.
Exactly.
I understand the toll booth model, but I have to push back on something here because it kind of contradicts everything I've learned about how high-octane tech growth stocks operate.
Okay, what's that?
So dLocal's revenues are up 65%. Yet our sources show they distribute 30% of their free cash flow to shareholders as a springtime dividend.
Right, the dividend.
Yeah, they paid out 19 cents a share in June, which is about a 1.5% yield.
Wait, why is a hypergrowth tech stock paying a dividend like some slow-moving utility company? Shouldn't they be burning every cent to capture more market share?
It's a totally fair question. It's a highly unusual financial profile, but it speaks to the underlying health of their specific software model. dLocal's net income rose 63%, and their adjusted free cash flow more than doubled. And free cash flow is, the actual money left in the company's bank account after they've paid the staff, kept the servers running, all that stuff.
Right, and the reason that number more than doubled is due to capital efficiency. Unlike Mercado Libre, which has to buy physical delivery vans and build massive warehouses to grow.
Local is pure software.
Exactly. Pure software. Once they write the code to connect that European merchant to the Egyptian banking system, the cost to process the second transaction or the 2 millionth transaction is virtually zero.
Wow. So the toll booth is already built and the cars driving through it just represent pure profit?
Right. They're generating cash so efficiently that they can fully fund their aggressive global expansion, enter new countries, and still have massive piles of cash left over.
That's incredible.
Yeah, offering a decent payout for income investors while maintaining an explosive 65% revenue growth, it's this rare dual-threat model. It points to incredibly efficient cash generation.
Okay, so Mercado Libre shows us the hidden financial army, and dLocal shows us the invisible cross-border plumbing. I want to transition to our third company, which is an entirely consumer-facing behemoth.
Yes.
They're dominating Latin America, but they're actively trying to cross a very specific border into the United States. Let's talk about New Holdings.
The parent company of Nubank, the sheer scale of this operation is, well, it's difficult to overstate.
It really is. They currently hold 131 million accounts across Brazil, Mexico, and Colombia.
Yeah.
But let me drop this jaw-dropping stat from the sources. 62% of all Brazilian adults now have a Nubank account. 62%.
It's unbelievable. Capturing 62% of an entire nation's adult population is a level of market dominance that most traditional retail banks could study for decades and never replicate.
And their financials totally reflect that scale. Revenue climbed 57%, and net income jumped 62%.
And, to understand how they captured over half the adult population, we have to look at what they disrupted.
Right, the legacy banks.
Exactly. Before Nubank, the Brazilian banking sector was highly concentrated among a few legacy institutions that charged exorbitant fees, offered terrible customer service, and literally required customers to wait in physical lines for hours just to open a basic account.
Or get a credit card, yeah.
Right. Nubank came in with this bright purple credit card, 0 fees, and an app that took 3 minutes to set up. They completely bypassed the physical branch model.
Here's where it gets really interesting, though. You read about that dominance in Latin America, and you assume they'll just keep expanding south, right?
Naturally.
But our sources highlight this recent move that seems entirely disconnected from their core market. New Holdings just secured the naming rights for the new stadium in Miami.
Oh, the one where Lionel Messi's team plays?
Exactly. And to the listener, this might just sound like an egocentric vanity project. Like, why is a Brazilian digital bank buying stadium rights in Florida?
Well, if we connect this to the bigger picture, the strategy becomes incredibly clear. New Holdings also recently received conditional approval for a U.S. national bank charter.
Wait, really?
Yes, and it goes into effect in January of 2026.
Oh, wow. So the stadium deal isn't just vanity at all. It's a highly calculated chess move.
Exactly. It's a strategic chess move. By combining that U.S. bank charter with the growing Latin American population in the U.S., and obviously the region's infatuation with soccer is positioning itself to ramp up stateside operations.
That is brilliant. They already have brand awareness with a community that might feel underserved by traditional American legacy banks.
Right. And furthermore, despite this high-margin business and explosive growth, New Holdings is actually the cheapest of the 3 stocks we've talked about today on a price-to-earnings basis.
It was like the cheapest.
Yeah. It's trading for less than 13 times next year's profit target.
Less than 13 times next year's profit. That is wild.
Yeah.
So what does this all mean? I mean, for you, the listener, building your intellectual toolkit. The reason this deep dive is so valuable is because it really challenges home country bias.
Oh, absolutely.
We naturally assume the most innovative companies are in our own backyards. But While U.S. fintechs are growing at 4%, looking globally reveals companies growing at 45 to 65%.
And they're trading at massive discounts of up to almost 40% off their recent highs.
Right. You have superior growth, potent net margins, and these regions are still early in their online migration. It just makes this a vital space to understand.
It really does. And I want to leave the listener with a final kind of lingering question to ponder long after this deep dive ends.
Okay, let's hear it.
We've just seen that New Holdings has captured 62% of the adult population in Brazil, and they've now secured a U.S. banking charter.
Right.
So if a foreign fintech has perfectly honed a playbook capable of capturing more than half of an entire nation's adult population, what happens to the traditional U.S. banking giants when that exact same playbook is fully unleashed on American soil?
Oof, that is a fantastic question. It's going to be fascinating to watch. Keep an eye on the data, and we'll catch you on the next deep dive.